While everyone's chasing the latest crypto hype or betting everything on tech stocks, a silent wealth transfer is happening in the precious metals market, and most investors are completely unprepared for what's coming next. Look, I've watched countless portfolios get absolutely destroyed because people treat gold and silver like they're the same animal. They're not. Gold zigs when silver zags. One protects you during deflation, the other explodes during industrial booms. And if you don't understand these cycles, you're not just leaving money on the table, you're actively gambling with your financial future. Right now, we're at a critical inflection point. Central banks are buying gold at record levels. Silver's industrial demand is skyrocketing with the green energy revolution. But here's the kicker. Timing is everything. Buy at the wrong point in the cycle and you'll watch your portfolio bleed for years. In this video, I'm breaking down the exact market cycles that control gold and silver prices, revealing the indicators the big institutions use to time their entries, and showing you the proven strategies to protect and grow your wealth no matter what the market throws at you. Alright, welcome back to the channel. If you're new here, I'm someone who's spent the last 15 years navigating the precious metals markets, making mistakes so you don't have to, and learning the hard lessons that come from watching portfolios swing wildly based on cycles that most people don't even know exist. And today we're going deep into something that could fundamentally change how you think about protecting your wealth. Let me start with a story that might sound familiar. Back in 2011, I had a friend who liquidated a significant portion of his retirement account to go all in on silver. He'd been reading about the imminent collapse of the dollar, watching videos about hyperinflation, and he was convinced that silver was about to shoot to the moon. And you know what? For a brief moment, he looked like a genius. Silver hit nearly $50 an ounce that year. He was sitting on massive gains, feeling invincible, telling everyone at dinner parties about his brilliant investment move. But here's where the story takes a dark turn. He didn't sell. He didn't understand market cycles. He thought this was just the beginning of an infinite climb. Within a year, silver had crashed back down to the high 20s. Within a few more years, it was trading in the teens. He held on the entire way down, convinced it would recover, and by the time he finally capitulated and sold in 2015, he'd lost more than half of his initial investment. That's not just a number on a screen, that's real money, real retirement savings, real financial security that vanished because he didn't understand one fundamental principle. Precious metals move in cycles. And if you don't respect those cycles, they will absolutely demolish you. Now, I'm not telling you this story to scare you away from gold and silver. Quite the opposite, actually. I'm telling you this because understanding these cycles is the difference between building generational wealth and watching your portfolio slowly bleed out over years of frustration and regret. The precious metals market is not a straight line up. It's not a safe haven that just sits there appreciating steadily like some people want to believe. It's a dynamic cyclical market influenced by everything from central bank policy to industrial demand, from geopolitical tensions to technological innovation. And if you can learn to read these cycles, if you can position yourself correctly within them, you can not only protect your wealth, but grow it substantially while everyone else is panicking. So let's talk about what these cycles actually are. When we look at gold and silver over the past century, we see clear, repeating patterns. There are bull markets that can last anywhere from 5 to 15 years, where prices climb relentlessly, rewarding patient holders and creating enormous wealth. Then there are bear markets, sometimes equally long, where prices stagnate or decline, shaking out weak hands and testing the resolve of even the most committed investors. Within these major cycles, there are also smaller cycles, seasonal patterns, technical corrections, sentiment-driven swings that create opportunities for those paying attention. The key insight here is that these cycles are driven by fundamental forces that we can identify and track. They're not random. They're not unpredictable chaos. They're the result of supply and demand dynamics, monetary policy decisions, inflation expectations, currency movements, and industrial consumption patterns that we can observe and analyze. Let's start with gold, because gold is the foundation of any precious metal strategy. Gold is primarily a monetary metal. Yes, there's some industrial use, and yes, jewelry demand is significant. But the real driver of gold prices over the long term is its role as a store of value and a hedge against monetary debasement. When people lose faith in fiat currencies, when central banks are printing money at unprecedented rates, when inflation is eroding purchasing power, where do they turn? They turn to gold. This has been true for thousands of years, and it remains true today. The gold bull market that ran from 2001 to 2011 was driven primarily by concerns about excessive money printing following the dot-com crash and then the financial crisis of 2008. Central banks around the world were engaged in unprecedented monetary expansion, and smart investors recognized that this would inevitably lead to currency devaluation. Gold went from around $250 an ounce to over $1,900 at its peak. That's more than a seven-fold increase. People who understood the cycle and positioned themselves early made fortunes. But then the cycle turned. From 2011 to 2015, gold entered a brutal bear market. Why? Because the dollar strengthened, because real interest rates rose, because the economy appeared to stabilize, and because sentiment shifted from fear to complacency. People started believing that central banks had everything under control, that we'd avoided catastrophe, and that there was no longer any need for portfolio insurance in the form of gold. The metal fell from $1,900 to just over $1,000, wiping out years of gains for those who bought at the top. This bear market tested the conviction of even the most dedicated gold bugs, and many capitulated near the bottom, selling at a loss just before the next bull cycle began. And that's exactly what happened. Starting around 2016 and accelerating through 2019 and 2020, gold entered a new bull market. What changed? Central banks went back to aggressive monetary expansion. Interest rates were slashed to near zero and then into negative territory in many countries. Government debt exploded to levels previously thought impossible. The COVID pandemic triggered the most aggressive fiscal and monetary stimulus in modern history. And once again, smart investors recognized the cycle turning and positioned themselves accordingly. Gold surged past its previous all-time high, eventually reaching over $2,100. Those who understood the cycle and bought during the bear market between 2015 and 2018 doubled their money or better. Now, silver is a completely different animal, and this is where a lot of investors get confused. Silver has this dual nature that makes it both incredibly exciting and incredibly volatile. On one hand, silver is a monetary metal like gold, with a long history as currency and a store of value. People buy silver for many of the same reasons they buy gold: protection against inflation, distrust of fiat currency, portfolio diversification. But on the other hand, silver is predominantly an industrial metal. More than half of annual silver demand comes from industrial applications: electronics, solar panels, medical devices, batteries, water purification systems, and countless other technologies that are essential to modern life. This dual nature creates a unique dynamic where silver responds both to monetary factors like gold and to economic growth and industrial demand like copper or other base metals. This is why silver is so much more volatile than gold. During bull markets, silver tends to outperform gold dramatically. When both monetary concerns and economic optimism align, silver can absolutely explode to the upside. We saw this in 2011 when silver nearly hit $50. We saw it again in 2020 when silver rallied from $12 to nearly $30 in a matter of months. The gains can be breathtaking, but the flip side is equally dramatic. When the cycle turns, silver crashes harder than gold. It's not uncommon to see silver lose 60, 70, even 80% of its value from peak to trough during bear markets. This volatility is not a bug, it's a feature. It's the price you pay for the potential of outsized gains. But you have to understand what you're getting into. Silver is not for the faint of heart. It's not something you buy and forget about. It demands active management, an understanding of cycles, and the emotional fortitude to handle wild swings. So how do we actually use this information to protect and grow our portfolios? This is where strategy becomes crucial. The first principle is diversification across both metals and across time. You don't put all your eggs in one basket, and you don't try to time the absolute bottom or top of the market. Instead, you build positions gradually, understanding where we are in the cycle and adjusting your allocation accordingly. When we're in the early stages of a bull market, when sentiment is still negative, when prices have been depressed for years, when nobody wants to talk about gold and silver anymore, that's when you want to be accumulating aggressively. This is the accumulation phase. And it's where the real wealth is built. You're buying when assets are cheap, when fear and apathy have driven prices down to levels that don't reflect the fundamental reality of monetary debasement and industrial demand. The middle phase of a bull market is where things get exciting. Prices are rising, media attention is increasing, more investors are piling in, and momentum is building. This is where you want to hold your positions, let them run, and resist the temptation to take profits too early. Yes, there will be corrections along the way. Yes, there will be moments of doubt, but if the fundamental drivers of the bull market remain intact, if central banks are still printing money, if government debt is still exploding, if industrial demand is still strong, then you stay the course. This is where patience pays off. This is where the big gains happen. The late stage of a bull market is where discipline becomes essential. This is when everyone is talking about gold and silver. This is when your barber is giving you stock tips about mining companies. This is when mainstream financial media is running breathless segments about precious metals every single day. This is when prices are making parabolic moves, when euphoria replaces rational analysis, when people are convinced that this time is different and prices will just keep climbing forever. And this is exactly when you need to start taking profits. Not all at once, necessarily, but gradually, systematically, reducing your exposure and locking in gains. Because what comes next is the bear market, and you do not want to ride that elevator all the way back down. Bear markets in precious metals are psychologically brutal. They grind on for years, slowly eroding confidence, shaking out believers, punishing those who refuse to accept that the cycle has turned. But here's the thing, bear markets are also where the next cycle begins. They're where the smart money starts accumulating again, quietly, patiently, while everyone else has given up. Understanding this cycle, accepting it as a natural and necessary part of the market is what separates successful precious metals investors from those who buy high, panic sell low, and never build lasting wealth. Now let's talk about some specific indicators that help us identify where we are in these cycles. One of the most important is the gold to silver ratio. This is simply the price of gold divided by the price of silver, and it tells us how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has fluctuated between about 50 to 1 during bull markets and as high as 100 to 1 or more during bear markets. When the ratio is extremely high, it suggests that silver is undervalued relative to gold, and that often marks an excellent opportunity to accumulate silver. When the ratio is low, it suggests silver may be overextended and due for a correction. This isn't a perfect timing tool, but it's an incredibly useful gauge for relative value between the two metals. Another critical indicator is real interest rates, the nominal interest rate minus the inflation rate. Gold, which pays no interest and costs money to store, becomes less attractive when real interest rates are high, because investors can earn positive returns in bonds and other fixed income instruments. But when real interest rates are negative, when inflation is running higher than the yield on government bonds, gold becomes extremely attractive because it preserves purchasing power while bonds are guaranteed to lose value in real terms. We can look at the real yield on Treasury inflation-protected securities, or TIPS, as a proxy for real interest rates. And historically, there's been a strong inverse correlation between real yields and gold prices. When real yields are falling or negative, gold tends to rise. When real yields are rising significantly, gold tends to struggle. Central bank policy is another crucial factor to monitor. When central banks are in easing mode, cutting interest rates, expanding their balance sheets, engaging in quantitative easing, this is generally bullish for precious metals because it represents monetary debasement and currency depreciation. When central banks are tightening, raising rates, shrinking balance sheets, talking about fighting inflation, this tends to be challenging for gold and silver. At least in the short term, because it strengthens the currency and raises opportunity costs. However, there's a nuance here that's important to understand. If central banks are forced to tighten into a weakening economy, if they're trying to fight inflation but economic conditions are deteriorating, this can actually be bullish for precious metals, because it sets up a scenario where they'll eventually have to reverse course and ease again, often more aggressively than before. Sentiment indicators are also incredibly valuable. When investor sentiment toward gold and silver is extremely negative, when positioning is at historic lows, when nobody wants to own these assets, that's often the best time to buy. Conversely, when sentiment is euphoric, when everyone is piling in, when positioning is at extreme levels, that's when caution is warranted. We can measure sentiment through surveys, through positioning data in the futures markets, through fund flows into precious metals, ETFs, and mining stocks. These indicators aren't perfect, and they can stay at extreme levels longer than seems rational, but they provide valuable context about where we are in the emotional cycle of the market. Let's also talk about the mining stocks, because this is an area that offers tremendous leverage to metals prices, but also comes with additional risks. When gold and silver are in bull markets, mining stocks typically outperform the physical metals significantly. A 10% move in gold might translate to a 20 or 30% move in well-positioned mining stocks because of operating leverage. The company's costs are relatively fixed, so higher metals prices flow directly to the bottom line as profit. During the bull market from 2001 to 2011, many mining stocks returned 10, 20, even 50 times the initial investment. The gains were astronomical for those who positioned correctly, but the flip side is equally dramatic. During bear markets, mining stocks get absolutely crushed. They often decline by 80 or 90% from their peaks, wiping out years of gains and bankrupting companies that were over-leveraged or poorly managed. This is why mining stocks require even more careful analysis and active management than the physical metals. You need to understand the company's cost structures, their reserve quality, their management teams, their balance sheets, and their ability to survive and thrive through the inevitable cycles. You can't just buy any mining stock and hope for the best. You need to be selective, focusing on companies with low production costs, strong balance sheets, competent management, and assets in politically stable jurisdictions. One strategy that many sophisticated investors use is to build a core position in physical metals, actual gold, and silver coins or bars that you own outright, and then add satellite positions in mining stocks for additional leverage during bull markets. The physical metals provide the foundation, the insurance policy, the wealth preservation component. The mining stocks provide the opportunity for outsized gains during favorable market conditions. This combination allows you to participate fully in bull markets while maintaining protection during bear markets. Storage and security of physical metals is another important consideration that often gets overlooked. If you're going to own physical gold and silver, you need a plan for secure storage. Some investors prefer to keep metals at home in a safe, giving them immediate access and avoiding counterparty risk. Others prefer professional vault storage through companies that specialize in precious metals, which provides better security and insurance, but introduces a counterparty that you need to trust. There's no one-size-fits-all answer here. It depends on your personal situation, the amount of metal you're holding, and your comfort level with various risks. What's important is that you think through these issues before you need to and have a clear plan in place. Tax considerations are also crucial for anyone building a precious metals portfolio. In many jurisdictions, precious metals are treated as collectibles for tax purposes, which means capital gains are taxed at higher rates than stocks or bonds. In the United States, for example, long-term gains on physical gold and silver are taxed at a maximum rate of 28% rather than the 20% maximum rate on stocks. This can significantly impact your after-tax returns, so it's important to factor this into your planning. Some investors use precious metals IRAs or other tax-advantaged structures to mitigate this issue, though these come with their own rules and limitations that need to be carefully understood. As we look at the current market environment in early 2026, we're at a fascinating juncture. Government debt levels globally are at all-time highs. Central banks, despite talk of fighting inflation, are still running balance sheets that are massively expanded compared to pre-2020 levels. Geopolitical tensions remain elevated. The transition to green energy is driving unprecedented industrial demand for silver. Real interest rates, while higher than they were during the pandemic, remain relatively low by historical standards. These are conditions that have historically been supportive of precious metals. At the same time, we need to be realistic about risks. If economic growth accelerates significantly, if productivity improvements from artificial intelligence and other technologies create genuine deflation in certain sectors, if central banks manage to engineer a soft landing and maintain policy discipline, these could present headwinds for precious metals. The market is never a sure thing. There's always uncertainty. The goal isn't to predict the future with perfect accuracy. That's impossible. The goal is to understand the cycles, position yourself appropriately based on probabilities and risk-reward, and adjust as conditions change. One of the most powerful concepts in precious metals investing is this idea of asymmetric risk-reward. When you buy gold or silver in the early stages of a cycle, when sentiment is negative and prices are depressed, your downside risk is relatively limited because you're buying near fundamental support levels. But your upside potential is enormous because bull markets in precious metals can last for years and multiply prices several times over. This is the opposite of many popular investments today, where assets are priced for perfection and any disappointment leads to dramatic declines. Precious metals, when purchased at the right point in the cycle, offer the potential for substantial gains while limiting downside risk. That's a powerful combination that's hard to find in today's market environment. The key to all of this is education, patience, and discipline. You need to educate yourself about these cycles, about what drives precious metals prices, about the difference between gold and silver, about how to evaluate mining companies, about storage options and tax implications. You need the patience to buy when others are fearful, to hold through corrections and periods of doubt, to let bull markets run their course rather than taking profits too early. And you need the discipline to sell when others are euphoric, to rebalance when positions get too large, to avoid chasing momentum, and to stick to your strategy even when it's emotionally difficult. This isn't a get-rich-quick scheme. It's not about making a fortune overnight. It's about understanding deep, fundamental cycles in the financial markets and positioning yourself to benefit from forces that have been at work for centuries and will continue to be at work for decades to come. It's about recognizing that governments will always be tempted to inflate away their debts, that central banks will always prioritize short-term political expedience over long-term monetary discipline, that industrial demand for silver will continue to grow as technology advances, and that throughout all of this, gold and silver will maintain their role as stores of value and protectors of wealth. So where do you start? Begin by assessing your current portfolio and determining what percentage should be allocated to precious metals based on your age, risk tolerance, and financial goals. For most investors, somewhere between 5 and 20% is appropriate, with younger investors who can handle volatility perhaps at the higher end, and older investors focused on preservation at the lower end. Then start educating yourself about the current cycle, read, watch videos, follow reputable analysts who have track records of success in this space. Begin accumulating physical metals gradually, dollar cost averaging into positions rather than trying to time the perfect entry. Consider adding mining stocks once you've built a foundation in physical metals and have developed the knowledge to evaluate companies properly. Most importantly, commit to this for the long term. Precious metals aren't something you dabble in for a few months and then abandon. They're a core component of a diversified portfolio designed to weather any storm, to preserve wealth across generations, and to provide opportunities for growth when traditional assets struggle. The investors who succeed in this space are those who understand the cycles, who position themselves early, who have the patience to hold through volatility, and who have the discipline to take profits when appropriate. It's not easy. It requires work, education, and emotional fortitude. But the rewards, both in terms of wealth preservation and growth, can be truly life-changing for those willing to put in the effort.